Warren Buffett has just executed a move he hasn't made in decades. Historically, every time he has done this, a major market upheaval has followed. Many seasoned investors now believe Buffett is subtly signaling a warning. Recent actions are sparking intense speculation. As of the first quarter of 2025, Berkshire Hathaway's cash reserves surged to an unprecedented $347.7 billion, more than double the $167 billion it held just over a year ago. But the significance isn't merely in the sheer size of the cash pile, it lies in the pattern underpinning it. Buffett has been a net seller of equities for 9 consecutive quarters, trimming stakes in stalwart companies like Apple and Bank of America, names he has long championed. To veteran investors, this is not mere prudence, it's a potent signal. The convergence of record cash holdings and persistent stock sell-offs leads many to believe that Buffett is bracing for a substantial market correction. While he has not overtly forecasted a crash, his investment conduct is widely interpreted as a cautionary sign about the present market environment. Buffett has amassed significant cash hoards in the past, often just before major market downturns. Let's rewind to 1999, on the cusp of the dot-com bubble bursting. Berkshire then held approximately $15.5 billion in cash. You might scoff, saying $15.5 billion pales in comparison to today's $347 billion. However, Berkshire was a much smaller entity back then. The stock price hovered around $30,000, compared to over $800,000 today, making the company roughly 25 times larger. This cash reserve represented a substantial portion of Berkshire's assets at that time. Buffett faced criticism and was derided as a dinosaur for steering clear of the speculative tech frenzy, famously admitting he didn't understand the sector. But what did he truly mean? He wasn't saying he didn't grasp how computers work or the mechanics of buying stocks. Rather, his principle has always been, if he cannot accurately forecast a company's earnings 10, 20, or 30 years into the future, he avoids investing. It's the too complex pile. Back then, tech was nascent and most dot-coms weren't profitable, so Buffett wisely kept substantial cash on hand. When the tech bubble burst, his patience shielded him from heavy losses. Fast forward to early 2008, just before the financial crisis deepened. Berkshire's cash reserves had ballooned to $44.3 billion, triple their previous levels. These sizable cash positions empowered Buffett and Berkshire Hathaway to seize investment opportunities during the subsequent downturn, such as his famous investments in Goldman Sachs and other firms during the '08 crisis. Buffett has often recounted how he would sit in the bathtub, contemplating how to restore confidence in banks and the broader economy while profiting from the turmoil. Today, Buffett's actions evoke an uncanny resemblance to those past moments. Over 56% of Berkshire Hathaway's portfolio is parked in cash, earning a modest 4.5% in short-term treasuries. Given his impeccable track record, many fear he perceives risks others overlook. Historically, when Buffett holds back like this, a storm on Wall Street usually looms. Some may argue he's been accumulating cash for a while, which is true. But even Charlie Munger, before his passing over a year ago, remarked that this is the toughest market he's ever encountered. Imagine a 97 or 98-year-old investing legend saying that the current market is the hardest of his long career. That's telling. Review the last 12 quarters of Berkshire Hathaway's activity. 10 of those have been net selling quarters. Why would Buffett, a man famed for his buy and hold forever philosophy, be unloading shares now? At the 2025 Berkshire Hathaway annual meeting, Buffett addressed holding $347 billion in cash.
We came pretty close to spending $10 billion not that long ago, for example. But we'd spend $100 billion. I mean, and those decisions are not tough to make. When something is offered that makes sense to us and that we understand and offers good value and where we don't worry about losing. And the one problem with the investment business is that things don't come along in an orderly fashion, and they never will. I mean, it isn't like every day. The long-term record is sensational, but that is not a product. And I've had 200 trading days times 80 years. Yeah, man, at 16 million trading days, it'd be kind of, 16,000 trading days. It would be nice if every day you got 4 opportunities or something like that, and and they were expected to be equally attractive. If I was running a numbers racket, every day would have the same expectancy of that I would keep 40% of whatever the handle was, and so the only question would be is how much we transacted. But we're not running that kind of a business, and so we're running a business which is very, very, very opportunistic. And Charlie always thought I did too many things. He thought if we did about 5 things in our lifetime, we'd end up doing better than if we did 50, and that we never concentrated enough. So that we would rather have, if we've got $335 billion now in treasuries, we would rather have conditions that are developed where we would have like $50 billion or something like that. But that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times. And we don't think it's improper, actually, for people who are passive investors just to make a few simple investments and sit for their life. But we've made the decision to be in the business, so we think we can do a little better than that by behaving in a very irregular manner.
The intriguing pattern shows cash reserves climbing sharply during market peaks and plunging after crashes, such as after the dot-com bubble, the 2008 financial crisis, and the COVID-19 pandemic. Is this a coincidence? In his annual letter, Buffett mentioned seeing no compelling opportunities to buy, preferring instead to wait for more favorable market conditions. This strategy mirrors his approach during previous market bubbles when he increased cash holdings anticipating downturns. Buffett isn't hoarding nearly $350 billion because he fears a crash. He's doing so because he believes the market is overvalued. That's classic Buffett. He never throws money at overpriced assets just to chase quick returns. He waits patiently. Buffett strikes only when value is present. We saw this in 1999 when he warned of low returns ahead while the market was euphoric, staying in cash as the dot-com bubble burst, earning minimal losses. The same story unfolded in 2007 when he held $44 billion in cash, only to deploy $20 billion during the financial crisis on distressed yet fundamentally sound companies. Today, stocks are extremely expensive. The market capitalization to GDP ratio, Buffett's favorite valuation metric, famously called the Buffett indicator, is over 100% above its historical average. During the dot-com bubble, it peaked around 55%. Now it's well above 100%. Berkshire, now a gargantuan company with $350 billion in cash, can only target colossal investments. Yet, the Magnificent Seven tech giants, collectively valued at over $16 trillion, dominate the market. Buffett's $350 billion could buy roughly 2% of those firms, but he's not doing so because they're simply too expensive. This cash hoard signals Buffett is waiting to shoot the big elephants. Everyone praises these giants as the best stocks, yet Buffett isn't buying because he sees no value. Today's stock market isn't just pricey, it's more overvalued than during the dot-com bubble. The only comparable time was before the Great Depression. Buffett's go-to metric, the stock market to GDP ratio, reinforces this perspective. Another key indicator, the 10-year cyclically adjusted price-to-earnings ratio, CAPE, normalizes earnings for inflation over the past decade. Historically, the CAPE averaged 17.74. Today, it sits at 38.35, a staggering 116% overvaluation. Over time, this ratio has trended upward, reflecting modern market reality. Certainly, the nature of business has evolved. A century ago, generating wealth required building factories and capital-intensive operations. Today, platforms like Instagram sold for billions with just a few dozen employees. To be clear, we're not predicting an imminent crash, but based on current valuations, the likelihood of earning more than 5% annually over the next decade appears slim. Is it impossible? No. It could happen if inflation skyrockets, as it has in recent years. That's the trade-off, inflation or a market correction. No one knows the future. We all want to make money in stocks. That's natural, but chasing the market when it's irrationally expensive is a gamble, not investing. Buffett reminds us that the best offense is a strong defense. Hold cash, be patient, and wait for the right moment to strike. In conclusion, Buffett's $347 billion cash mountain is a powerful message to all investors. When the Oracle of Omaha hoards cash like this, it's time to take notice. The market may not crash tomorrow, but history shows that when Buffett piles up cash this aggressively, it's a sign that the storm clouds are gathering. Are you prepared to weather the coming storm? If you found this breakdown insightful, don't forget to like, subscribe, and share your thoughts in the comments.